You're listening to What's Up Digital Lending, the podcast that explores the exciting world of digital lending. We make a deep dive into the most important issues and talk to the leading minds of the ecosystem. In this episode, we are podcasting live from the first Consumer Finance Summit in Cologne on October 27th. The digital lending market has grown rapidly across Europe in recent years. In the first half of 2022, the share of online consumer loans in Germany amounted to more than 30%. The Consumer Finance Summit provided an in-depth look into the market and what opportunities are available to investors. Welcome to the show. Join Konstantin Fabricius as host and his two guests, Christian Finke and Philipp Kriependorf. Christian Finke is managing director with Monega, an investment company from Cologne in Germany. Among other things, he is responsible for portfolio management and sales to institutional clients. Philipp Kriependorf is co-founder and co-CEO with Aux Money from Düsseldorf in Germany. Aux Money is one of the largest digital lenders for consumer loans in Europe. Now, pay attention, please. The content of this podcast is expressly not to be considered an investment recommendation, but it is intended solely for your information.
Hello, Christian Finke. Happy to have you here in our first podcast, Digital Lending, What's Up? And hello, Philipp Kriependorf. Happy to have you here. And yes, we are here in Cologne on the first Consumer Finance Summit. And the audience may hear in the background the voices of our fellow guests. Yes, it is really a live recording. And what I would really like to talk with you about is the summit. What is your impression, Christian?
Firstly, I was really amazed by seeing so many interested people in the space, because from an investor perspective, particularly outside of maybe family offices and high net worth individuals, for institutional clients, there are not that many summits, conferences, seminars in Germany on that topic. So that was really well established.
Yeah, I was really amazed about that too. When I came here, I was astonished about how many people actually showed up. It's really good, especially because it's the first of its kind, right?
Right. Yeah, it's first of its kind. And to all we know, it's unique in Europe. We don't have such a format nowhere. And we know this from the United States or from Asia, but we pull together originators with institutional investors. So that's really unique. And well, speaking for the association, yes, I'm really very happy about it. And in particular, very happy that we have done it together with Nordics and Monega, our partners here to organize this event. Okay. But let's talk details. What is your key takeaway of today's summit regarding the content? What is really what you take back home?
I think that we're on the path really to establish an asset class. I hope it's here to stay because, as we have discussed earlier on, clearly due to higher rates, the investment for the platforms becomes more difficult. They hopefully have enough financial power. They have enough leverage on their platform that they can stay on course. And that would mean for us that we have enough time to do the educational work with investors in order to make it a suitable asset class for them.
We might be on the path, but my impression was that we're still quite at the beginning, at least in Europe. My overall impression of the summit was that I think the landscape's pretty generic still. I think there are well-established players, a few, very few, that are generating assets that could make up a product for institutional investors. I think we're really at the beginning because there's so many other players and there aren't any standards. Everything feels very unique in terms of size, in terms of market, in terms of quality. So I think there's still a bit of a way to go before that gets to be a broadly accepted investment product, especially for institutional investors that might be restricted in the ways they invest.
Agreed. I think it's still perceived as a banking product, probably through the dominant players. But my understanding is that, first of all, in Asia, the marketplace seems to be smaller nowadays, maybe due to economic, political frictions. And that means that we have the opportunity to establish something in Europe, which is not in significant amounts there, it's a chance to develop the place.
Absolutely. I mean, funding is key if this segment is going to be successful or not. I mean, if there's no funding for the platforms, then they won't be able to originate, and then that's it. I think it's different if you look at Asia, especially, or the United States, where the banking sector is not as overdeveloped as it is in Europe, especially in Northern Europe. I mean, the platforms have a different proposition, and I think it's much harder for them to find their place in the landscape. Right. And that's, I think, something that showed today as well. So we had someone from Switzerland, which seems to be a completely unique market in Europe, obviously. Feels like no risk at all. Fantastic. Returns are okay, but why not? I mean, that was really interesting to hear.
For us, it would hopefully constitute something new, really a new asset class. As you said, in the US, Asia, it's more mainstream already. But specifically in the US, I mean, they are so much used to any kind of structured products, any kind of transparency, any kind of securitization. Since the financial crisis, I think Europe has done a poor job to reestablish anything that goes beyond typical treasuries, covered bonds, and corporate bonds.
Absolutely. I couldn't agree more. And I think part is the culture, I think. We're very, very careful when it comes to new things. And once it didn't work out, then we don't want any of it at all. And then there's, I think, the EU that has a habit of regulating everything they can and regulating a lot of it away, and more so in the banking environment. And that's not helping. Definitely not in an international comparison.
Absolutely true. And I think we would like to be number one in regulation and in sustainability and things like that. On the other hand, we have to deliver returns with a decent risk. And I think we have to work hard, even do the lobby job, to make sure that our public, our institutional investors, our semi-professional investors get the chance to invest in decent enough and very well diversified products.
Yeah, absolutely. I mean, the fact that so many people showed up today and really asked quite informed questions shows that there is interest and that there might be demand if it's at all possible for them to invest and to understand it. There were a few questions that seemed very informed. They had deep knowledge of the market and the history, also the American market, like Lending Club and Prosper and so on and so forth. And on the other hand, I always had the feeling that a lot of people there in the audience had trouble following because they didn't know the basics. I always felt the need to explain actually what we are referring to when we say digital lending. I mean, who is a digital lender, who is not? What does he do? What's the distinction? What is the niche that he's playing in? Maybe it was just my impression, but I think there's also some groundwork to do, especially with investors. It's also an experience that we've made at Aux Money when we started talking to institutional investors 7 years ago. And still do. I mean, we've become more professional on both sides, ourselves and the investors that we talk to. But a lot of times we get questions, what is it that you do? I mean, what is digital lending? So I think there's some more work to do. It was the first conference of this style and with this topic, but I think we need more.
I guess both platforms and asset managers really have to try to accept that there are different terminologies with investors. So either they're speaking in a risk-return spectrum, and it's sometimes hard to get the data, the historical data on lending is not that old, the asset class. So our back tests are maybe looked at it with a insecure, unsure way. Is that valid? Have they seen various recessions? What happened? What happens if unemployment rises significantly? What would covenants do in certain scenarios? I think all of us, we have to do a more decent, a good job to make investors understand what is it all about. I mean, private debt, private equity clearly don't really 100% at the moment fit in the risk-return spectrum. Why? They don't price daily. It's a different animal. Still, it's our job to fit in asset allocation of either family offices and institutional investors and others. So that's certainly one significant place where we have to improve, but also, as you said, we have an enormous number of regulation coming over us on a new asset class. So our investors are currently under pressure to find the way through all the regulation, particularly ESG regulation, but also they need to ensure that, for example, their capital requirements are working in an asset class like lending, direct lending, or the funds that invest in direct lending. And also there, I mean, how does it work under Solvency II? How does it work under liquidity capital requirements and so forth? It's a challenge. It's a job we have to do, but I'm sure we will do.
Yeah, agree.
Well, yes, we are on a good way because we have now started today to develop together this asset class. Interestingly, talking with Americans about digital lending, they all know what it is. So it is so common. It has been common for more than 10 years now. Talking with people from Asia, it is so common. Why not here? Yes, I think this is one of the key questions. Why are we so late on this development?
As I said, I mean, Europe, especially Germany, is such an overbanked market. I mean, you have a small bank at every corner. You have the Sparkassen, you have the large corporate banks. Everybody is offering a loan product, and everybody is offering a loan product that is suitable for customers. The competition is huge for banks to acquire new customers, especially borrowers. And that's different in other markets. The United States, for example, I mean, they had a very, very well-developed credit card market. Everybody used it because it's so easy, but it was way too expensive for consumers. It was totally overpriced. So when the first digital lenders stepped in, it was really easy for them to just tell people, refinance your credit card debt. I mean, it's clear to everybody that it's risk-based pricing. It's cheaper for someone to have an installment loan, so everybody did it. That created huge volumes of digital lending quite early on. Created other problems for the lenders on the funding side, but still, I mean, they had an easy entry. In Asia, the market was rather unbanked or underbanked in comparison to Europe. So it's a little bit of a different start there. People are widely spread, huge countries. Next bank branch is hundreds of miles away, probably. So delivering products electronically just seems to be the right way. Small amounts, electronically assess risks because you don't see who's sitting there. You don't have access to centralized credit data. So it's a completely different market. And I think that's one of the reasons why the new segment has a harder stand in Europe. And we need to find things where we are better than banks. One thing certainly is the interaction with the customer and showing the customer what's possible to be able to do everything from home on a smartphone, really easy and quick, and only with the level of interaction that I really want. That certainly is one of the key drivers for digital lending in Europe. Banks are learning, thankfully not that fast. So I think we still have a head start there. On top of that, we have to find out what else we can offer that banks cannot. And I think one of the things, at least for us at Aux Money, is financial inclusion. I think there are still a lot of people, more than you might think, that don't have access to credit, that cannot take part in the financial supply of society. And I think that's where platforms like ours, like the ones organized in our trade organization, can do a valuable job of including more people more efficiently. And I think that's harder to do. We have to do a much better job than American platforms and than Asian platforms. But I think we're on a good way there.
I would like to add maybe a comparison between the US and Europe mainly, leaving Asia aside for a second. The US has been a single currency market for ages. It has been a huge market, a liquid market. So whenever you create a new platform, a new business idea, it's within that big market. So from day one, your opportunities are much larger than in Europe. Europe has become a single market in 2000, right? That's when the euro really hit us all, and we could start to establish across a good number of countries a business model with the same currency. However, with the consumer finance market, that was again created in single markets. It was not as if we had a European platform from day one. So if you take the history, the size of the market, and then eventually came the financial crisis, which had a much harder impact on Europe than it had on the US in terms of product development asset class acceptance, asset class maybe even being motivated to be invested in by central banks, by governments, by regulation. I would guess between 2007 when it all started and then into the low teens, maybe 12 to 13, it was really hard to establish something that wasn't as simple as a treasury bond, a corporate bond, or a covered bond. Anything that had to be structured, had to be pooled, was neither fostered by the investors themselves, nor by the European Central Bank, nor by the local politicians. So I think the start was really, really hard. And hopefully we don't get another break in that development in the next couple of years, but understand that it's helpful for all of us to have a new asset classes with different characters, but significant in size. I mean, the volumes that we've seen across the summit today, that is as large as some huge covered bond markets.
Let's talk a little bit about credit risk management. We have heard so much about it today, and what I find very interesting is that there are actually two different perspectives on the investor side. So they're the one who really like doing it by their own, and they really go into the nitty-gritty details and have a very high level of knowledge about the originators actually, about the techniques and all the things that are really necessary to roll out a high quality risk management. But on the other side, there are those, this is what we have heard today, which do not really like to go into the details, and they leave it to like the funds or other specialists. So what is your view on this?
As a platform, I can understand the demand of investors who think they can do a better job in selecting loans than we can, but I would never allow it. We've had the example of Lending Club. It was said that Lending Club allowed and still allows, which I wasn't aware of, still allows to cherry pick loans within the individual loan classes. And then on the other hand, it was said that in a few years back, if you would just buy vertical slice at Lending Club, you wouldn't be able to make money. There's a connection there, you know? I mean, if I allow someone to pick out the best loans in each risk class, what happens? I mean, the risk classes don't perform, because if the best ones are gone, then the rest is the crap, to be frank. It really creates a problem for the platform, and it did with Lending Club as well. They outgrew the problem because they were big enough with investors who took vertical slices. So they can afford to have a few investors that they allow to cherry pick because the impact is not that big on the asset. I would never allow it. It might be necessary for small platforms to start off, to get some funding at least. But I don't think it's a viable business model going forward. If these platforms survive, there might be a few that outgrow it, get as big as Lending Club, and then they don't have a problem with it. But I don't think I don't think it's a good practice for a platform. We've never allowed it at Aux Money. We've always looked at investor returns for each score class. In the end, it's a blend, obviously. But we've never even allowed investors to actually select score classes or anything. You have the problem, what do you do with the rest? I mean, if you have someone who only wants AA, A, and B, then you need someone to take C, D, and E. That's actually kind of management that we do. What we do, however, is we share data on a loan level with investors. So what we found makes the process easy, much easier, is if we talk to someone who knows what he does. If he understands how to analyze a loan portfolio, how to calculate internal rate of returns, how to calculate loss ratios, stuff like that. It's much, much easier if we have someone who we can discuss this.
Well, I guess my angle to the question would be, who has the data, who has the models, and who has the analytics of the platform and the manpower to come to the opinion that they can do a better loan selection than the platforms themselves and maybe specific or specialized asset managers. There will be a few. Clearly, there might be a few that can do the job. But if I look at our clients would be pension funds, medium-sized insurance companies, sometimes smaller institutional investors, maybe family offices. Now, these guys look at, God knows, let's say 20 asset classes with 10 people or maybe 12 people, can they afford 2 other, 3 other, 4 other analysts, data analysts, focusing on at the end of the day, minor part of the overall portfolio? Probably not. They don't have the leverage and it wouldn't be worthwhile. If it was an asset allocation where they would allocate 20, 30% of their portfolio, different matter. As we had discussed previously, it's still a small asset class in Europe. And therefore, we're talking about certainly single digits, maybe even 1% of people's asset allocation. So you better leave it with the specialized asset managers, the platforms, look at their models, look at the results that they take from that. And you have quant capabilities in your own shop so that there will be an educated discussion with the platforms or the asset managers or the asset managers. But will most investors tend to do it themselves? Probably not.
I agree. The institutional investors that spend the most of the money actually have people, because they are large institutions, to understand what we're talking about when we share that kind of data. If we want to make that asset class available to a broader audience, then we need some sort of middle layer, like a securitization, because that's what people understand. That's where you standardize risk and return profiles, and then that works. And that would require either platforms that are large enough to do it themselves, like we've done, or you need intermediaries that can do that job.
Exactly. I think that's the way into the market. I mean, some people might say, I'm large enough, I invest in the platforms themselves, or they invest directly in the platforms and get access to the data and the analytics, or they have the intermediaries in between.
Another issue we were touching on today was the outlook. And we have heard that ESG is really a very important issue in the future. So there we have very many different views on this, whether it is really important to have such in-depth ESG policy, or do we perhaps have other better approaches? What is your thinking on this, what you have heard today?
Right. I mean, clearly there's no way around sustainability and some form of standardization. However, at this point in time, I think there are a lot of people out there who are happy if they didn't implement processes, because how can you operationally risk-free establish a process that is not well defined? And unfortunately, the European ESG taxonomy, SFDR policies are not well defined. It's something that we have to face as a challenge and also as a risk day in, day out. So if I had the choice, I would lean back for 2 years. I don't have the choice, but I would, and see what will be the result. I mean, let it run for a year or two, and then hopefully we'll have a clearer picture of how sustainability for investments in certain asset classes would look like.
Yeah, that's a problem, I think. I mean, I was really amazed that we came through 2 panels and 1 speech without once hearing the word ESG, I think. And only, I think, on the second to last program point, it came up. Usually that doesn't happen nowadays. I mean, it's there, it's not going away. Everybody's talking about it. Certainly something that every institutional investor has on its mind, and I think with the same problems that you just described, it's a risk. Nobody knows what the outcome will be. Nobody knows how to structure it in a way that he will be compliant with something that everybody knows is coming, but nobody knows how it's going to look. We don't have that luxury to just lean back. So I think the best thing that we can do is try to figure out for ourselves what we can do right now, and do it if it's in any way possible in terms of costs, especially, and then see where especially the EU takes this. They've been working on this for quite some time now, and so far I've seen nothing that promises an easy outcome or a good outcome. I don't know. Don't
get us wrong. I think we would both agree that climate risk is there, and we have to do something. However, if the negotiations within Brussels, etc., don't get to terms, and even on the easiest of things, which is fossil fuel, gas, nuclear energy, etc., if they don't get to an agreement on those, we're still far away from any social or governance standards. I would have loved if they thought it through earlier on and give us really well-defined targets, but make sure that we actually receive the data. Because what happens is we as the financial industry, at the end of the day, are the front runner of something that the companies still have to deliver the data on. Think about the next couple of years in terms of, depending on what the size of the company is, your enterprise is, in terms of employees, you have to deliver the data either earlier or later. I think the latest bucket is in 2026. So what do? We have investments in smaller entities. We have investment in large entities which might deliver, but there are areas where you really, really struggle.
Yeah, absolutely.
Okay. Thank you, Christian and Philip. Today we just wanted to start with this new podcast, What's Up Digital Lending, and now we all would very much like to go to the reception, I think. And yes, it was very great to have you here with our number one. And we will certainly have another opportunity to exchange views at a later point of time. And yeah. Thank you very much to the audience for listening to our number one podcast. Please be with us the next time. Bye.
Thank
Bye.
you very much.
Thanks.
Pleasure.